everyone. I am Robbie Young, Vice President of Strategic Growth at CUInsight, and I'm excited for this second episode of a special four-part series of the CUInsight Network podcast brought to you by our friends at TruStage. In today's discussion on the 2026 economic outlook, I'm thrilled to be talking to Steve Rick, Chief Economist at TruStage. Welcome to the show, Steve. So let's jump right in.
Well, thank you, Robbie. Great to be here.
As we look ahead, what are you seeing in the broader economy, particularly around inflation, GDP, and workforce trends that credit union leaders should be paying attention to?
Yeah, right now we're looking, for 2026. Actually, we could see inflation pick up a little bit going into the first half of the year, mainly as firms start passing through more of those tariffs. Over the last, say, 6 months, a lot of the firms that have been importing goods in the United States have been kind of absorbing them, paying those tariffs themselves. But now that they look like they're going to be around for at least a couple of years here, they're going to pass them through to you and me, the end consumer. So when we go out shopping, we're going to see a little bit higher prices, maybe have inflation creep over 3% during the first half of 2026. Also, with our new immigration policies in this country, we're not seeing many people coming across the southern border, and we do have a lot of deportations taking place. Well, that's going to create pretty much a tight labor market. And so because of that, we could see higher wages, and, firms will pass on those higher wages in the form of higher prices to you and me. And that could also be a little inflationary impact. And so both of those could lead to higher inflation, which is why the Federal Reserve still has interest rates slightly above its long-run trend here.
Thank you so much for that information. All very important. There's been a lot of discussion around the Fed's rate path, like you mentioned. From your perspective, how do you expect interest rate cuts to unfold, and at what pace is most likely?
December 10th, the Federal Reserve did lower interest rates 1/4 of 1 percentage point. So they did drop it down just a little bit. We do expect them to drop it probably 50 basis points or 1/2 of 1% next year during all of 2026. That'll get us really close to what a lot of economists believe is like the neutral interest rate, right around 3%. What do I mean by neutral? Well, that means the Federal Reserve is not trying to stimulate the economy with low rates or restrain the economy with higher rates. That basically we're at about 3.6 now, and if the Fed takes it down all the way down to 3%, that'll be kind of right at neutral, kind of the Goldilocks level, if you will, of interest rates. So expect the Federal Reserve to lower interest rates, mainly because they're worried about the labor market. Right now the unemployment rate's around 4.4%. Economists think 4.5% is the perfect level of unemployment, or what we call full employment. And the Fed's worried about it, the 4.4 rising above that 4.5, maybe getting up to even, over that 4.7, 4.8, closing in on 5% unemployment rate. So they don't want that. That's why the Fed is slowly, what I like to say, putting their foot off the brake, if you will, of the car. If you think of the economy like a car, right now they have their foot on the brake, trying to slow the economy a little bit to bring inflation down, but they're slowly pulling their foot off of the brake and basically going to put their foot on the floorboard of the car sometime in 2026 when they get down to that 3% neutral interest rate.
So given those economic signals, what are you forecasting for credit unions in terms of loan growth, deposits, and overall earnings in the coming year?
Yeah, a little bit better when it comes to all of those. We're forecasting about 5% loan growth next year, a little bit above the 4.5% we saw this year, but it's kind of below our long-term average. In the long run, credit unions typically grow about 7% in loans. So if we only hit 5, it's going to be a little bit weak, still a little bit of headwinds. You may ask, what are those headwinds? Well, like I said, we still have interest rates slightly above neutral from the Federal Reserve perspective. Also, we have a lot of loans that were made a few years ago during 2022, when the Fed had interest rates really low. We made a lot of, say, automobile loans back then. And those loans are being paid off now. And so there's a lot of loan repayments are coming into credit unions, which if that's greater than loan originations, you could actually have loan balances shrink. And so that's going to be still a little bit of a headwind for credit union lending. And then also there's still a lot of fear and uncertainty out there with respect to the American consumer. They're still worried about maybe a recession and things like that, what's kind of going on in the geopolitical environment. And so that's keeping some people from buying that new car or that new house. When it comes to deposit growth, we're actually forecasting about 6% growth in total deposits at credit unions. That's good. That's a little bit better than what we saw last year of about 5%. So that is trending up. But once again, that's below the 7% long run kind of average. When it comes to the bottom line, credit union earnings, if you measure that with, say, the return on assets ratio, last year, credit unions earned about 61 cents for every $100 in assets under management. This year, we're forecasting it jumping from that 61 all the way up to 83, and then next year up to 85 cents for every $100 in assets. Once again, our return on asset ratio. The reason that is because we're seeing net interest margins, the difference between what we buy the money at, deposits, and what we sell the money at in loans, getting a little bit larger. But also operating expenses are being restrained. A lot of credit unions are, we call, bending the cost curve and trying to control operating expenses. And one of those ways we're controlling operating expenses is through artificial intelligence, AI, which of course is the big news story this year. You probably saw Time Magazine gave AI and the founders of AI as the person of the year type thing. And so AI is the big topic right now when I talk to a lot of credit unions around the country.
Yeah. And as you mentioned, AI, it definitely continues to evolve quickly. How do you see AI influencing credit union workforce strategies and future employee growth as we look into the future?
Typically, in the long run, credit unions add employees, about 3 to 4% growth in their labor force. So if you kind of use that as kind of long run average, 3-4% increase in total employees at credit unions. Right now, it's falling rapidly. The growth rate, anyways, that we're down to about 2%. I'm forecasting maybe only 1% growth in the labor force next year. And you may say, well, why is that? Well, it could be because of AI. AI is going to be very transformational for the credit union industry. It's basically affecting the amount of call center staff that you have. There's a lot of new AI products out there that really help call center staff become more productive. So you can do more, say, take on more calls with fewer workers. Also, same thing with loan officers. We have some AI-enabled loan origination software out there that's really increasing the productivity of those existing loan officers at credit unions. So maybe we don't need to hire new loan officers. And same thing with computer programmers. There's things like Copilot out there and other things like Claude that really help a computer programmer become way more productive so we can do more programming with fewer programmers. And you see that. If you look at the unemployment rate amongst recent college graduates, it's up to 9.7% right now. But this time last year, it was 6.8%. And I always like to compare, prior to COVID and the big disruption, prior to COVID in 2019, it was around, 7% back in September of 2019. So we're up to 9.7% today, even though the economy is pretty good. So we're seeing we have a little bit of concern that recent college graduates are having a difficult time breaking into the workforce because a lot of firms say, I really don't need anybody new right now because of AI.
Well, that was a ton of great information, Steve. Thank you so much. I truly enjoyed our conversation, and I know our audience appreciated those insights as well. To learn more, visit TruStage.com, and I'm looking forward to the next one. Thank you to all of our listeners for tuning in.